Welcome back to the deep dive. Today, we're setting everything else aside for a really focused look, a laser focus, actually, on one specific subject: the financial workings of Turkey's biggest fast food player.
That's right. We're dedicating this whole session to digging into the consolidated financial statements and activity reports for Tabgida Sanayi VAT Karet Ekarta Surat and its subsidiaries.
And the period we're covering is those crucial 9 months ending September 30th, 2025.
Yeah, and our goal here really is critical for any individual investor. We're taking these, dense, complex financial reports, all adjusted for inflation, mind you, all the key footnotes or dipnalar, and turning them into something clear, actionable knowledge.
Because just looking at the big headline numbers, especially revenue, it doesn't tell the whole story, does it?
Not even close.
Yeah.
You've got to look underneath. How is profit actually generated? How are costs being managed, or maybe not managed? And crucially, where's all this money going? We know they're expanding aggressively.
Okay, so let's start unpacking this. Our scope isn't just reading numbers off a page. It's about understanding this core tension within Tabagouda.
What tension is that exactly?
Well, you've got this company pushing hard on growth, opening stores like crazy, increasing sales volume. But at the same time, it seems like they're facing some really intense operational cost pressures.
That's the heart of it. We need to look at the scale, the core operational margins, which are, let's say, interesting, and then figure out what's driving that surprisingly strong net profit figure we see at the bottom line. And of course, the risks tied up in their structure.
And you mentioned inflation adjustment. We really need to stress this point, right? Every single number we talk about today.
Every single one. It's all inflation adjusted using Turkish accounting standards, specifically TMS 29. This isn't historical cost accounting. It's adjusted to the purchasing power of the Turkish lira as of September 30, 2025.
Which is the only way to make a fair comparison between 2024 and 2025 to see the real growth, the real efficiency.
Exactly. Without this context, the comparisons are basically meaningless in a high inflation environment. It's fundamental.
Absolutely. So if you find this kind of deep dive helpful, maybe you're prepping for a meeting, thinking about investing, or maybe you're just like us, genuinely curious about how these big companies tick, please do share this with others who might be interested.
Yeah, and follow the channel for more breakdowns like this.
Okay, let's jump right in. Part 1, getting to know the company, its massive footprint, and how it's governed. Right, first things first, we need to understand the basics. Tell us about Tabagouda. Where did they come from, and what's their position in the market?
Okay, so the group started back in 1994. Their headquarters are in Beşiktaş, Istanbul. Their core business is pretty straightforward on the surface: fast food.
But it's the scale that's really defines them, isn't it?
Precisely. They are positioned quite clearly as Turkey's largest fast food hamburger restaurant chain, specifically by store count. That number one position is critical. It shapes, well, pretty much everything they do strategically.
And they haven't just stuck to hamburgers. They've built this portfolio using a really smart dual model, haven't they?
Yeah, very smart. It gives them market reach and, a bit of resilience.
Mm-hmm.
So on one side, they act as the exclusive master franchisee for huge global names. We're talking Burger King, Popeyes, Sbarro, Arby's, and Subway.
Brands everyone knows instantly.
Exactly. Yeah. Media brand recognition, global pull. But on the other hand, they haven't neglected the local market. They own and are actively growing their own Turkish brands, Usta Dönerci and Usta Pideci.
Which must tap into a huge domestic market.
A massive market. So this mix lets them play in both arenas: the international quick service space and the huge demand for traditional Turkish food served quickly. It's quite agile.
That dual strategy seems powerful, but being a master franchisee means you're working with agreements, with timelines. These aren't forever deals, right? What do the reports say about expiration dates?
That's a really key detail for anyone thinking long-term. No, they're not perpetual. For instance, the main Burger King agreement, the Master Franchise Development Agreement, runs until December 1st, 2032. So still some time there.
Okay, that's a decent runway. What about the others?
Well, Popeyes is coming up much sooner. That agreement expires at the end of 2026. Subway is a bit further out, 2029.
So Popeyes is the one to watch in the near term.
Definitely. Now, given Tabagouda's scale and performance, you'd expect renewals to be likely. But any negotiation involves money, involves contract terms. It's never automatic.
So investors need to keep an eye on those dates, especially Popeyes, as a potential, maybe small, but real contractual risk point.
Absolutely. It's just part of the due diligence. #TAG 1.2 operational scale and growth.
Okay, let's talk scale. The story that streams from these reports is just rapid, relentless expansion. Can we put some numbers on that growth in the first 9 months of 2025?
The numbers are, frankly, staggering. As of September 30, 2025, they had 1,975 restaurants open, total.
Wow. And how does that compare to the start of the year?
Well, at the end of December 2024, they had 1,830. So, doing the math, they added 145 new restaurants in just 9 months.
145 stores in 9 months? That's more than 16 stores a month.
It is. That pace is incredible. It shows this massive ongoing push to grab market share, grab those prime retail locations. They are not slowing down.
How are they managing this? Is it all company-owned expansion, or are they using partners?
They lean heavily on the franchise model to scale up efficiently. The breakdown shows that strategy is working. The number of franchised restaurants grew too, from 820 at the start of the year to 878 by the end of Q3 2025.
So they added 58 franchise locations in that period.
Right. This lets them expand faster because the sub-franchise puts up the capital for the actual store build-out. Tia Vida can then focus on the brand, the supply chain, the management, and of course, collecting those franchise fees and revenues. It's a capital-light way to grow the footprint.
But opening that many stores, company-owned or franchised, requires people, a lot of people. What happened with their headcount?
This is maybe the most visceral indicator of just how fast they're moving. The average personnel headcount during the period jumped significantly. It went from 15,454 in the 2024 period to 18,134 in the first 9 months of 2025.
That's nearly 2,700 more people on average.
Around that, yes. Nearly 3,000 new people needing to be hired, trained, managed, integrated into the system in less than a year. It's a huge logistical undertaking.
And it immediately flags something we need to watch closely later.
Yeah.
Labor costs. That has to be a major factor in their financial health.
Oh, absolutely. We'll definitely see that playing a big role when we get to the profit and loss statement, hashtag 1.3, ownership and international presence.
Okay, structure. Who's actually in control of this fast-growing machine?
The ultimate controlling party, the main shareholder, is TFI, TB Gada, Yatirim Lara, Anon and Shirketi. They hold 79.9% of the shares.
TFI. So Tia Vega is part of a larger ecosystem.
Exactly. TFI is essentially the parent group. And this high level of control, nearly 80%, allows for very streamlined decision-making.
Yeah.
You can see how that enables the kind of aggressive expansion we're talking about. And it's also key to understanding the huge internal supply chain network we'll discuss later.
Makes sense. What about outside Turkey? Do they have operations elsewhere?
They do. It's a smaller part of the business currently,
Yeah.
but it's strategically established and fully consolidated in these reports. They own 100% of Teeb Georgia LLC, which runs 9 restaurants in Georgia,
Okay.
and also 100% of Teeb Limited Mekananish Dual Petrovec, which operates 16 restaurants in North Macedonia. Plus, they have a branch in North Cyprus.
So not a huge part of the revenue pie yet, but it shows they have a regional strategy. They're looking beyond Turkey.
Clearly, it signals an intent to export their successful models, both the global franchises and potentially their own brands, into neighboring markets. It's a platform for future growth. Hashtag tagged 1.4 governance and management compensation.
All right, last point in this section. Running an operation this big costs money at the top too. What do the reports tell us about what they pay their board and senior management?
Yeah, no top 5 gives us the details. For these first 9 months of 2025, the total short-term benefits, basically salaries and bonuses paid to the board of directors, and the key senior management team came to 84,490,560 Turkish lira.
84.5 million TL. And remembering, this is inflation adjusted. How does that stack up against the same period in 2024?
In the same 9 months of 2024, the inflation-adjusted figure was 75,466,963 TL.
So a noticeable increase then, about 9 million lira more in real terms.
It is. It shows that the management team's compensation grew slightly faster than the general rate of inflation, as measured by the two Findex used for the adjustments. You could interpret that as rewarding the team for navigating this aggressive growth path in a pretty volatile economic climate.
Maintaining their purchasing power, maybe slightly enhancing it.
Pretty much. It confirms that the leadership is, well, highly compensated, which you probably expect given the sheer scale and complexity of the business they're running.
Okay, that sets the scene perfectly. A huge, centrally controlled company expanding like mad, dealing with high internal costs and already planting flags internationally. Now let's get into the numbers and try to solve this financial puzzle. Before we even whisper the word revenue, we absolutely have to talk about the elephant in the room for any Turkish company report. Inflation accounting, TMS 29. Why is this so critical for anyone listening to understand?
It's everything. Honestly, without getting your head around this, the numbers are just misleading. TMS 29 mandates that companies in high inflation economies like Turkey have to adjust all their financial data. Not just this year's numbers, but the historical numbers they compare them to as well.
Adjusted to what?
Adjusted to the purchasing power of the currency at the balance sheet date. So in this case, every single lira figure we discuss from 2025 and 2024 is expressed in the lira's value as of September 30, 2025.
Okay, so let's say a company reported, I don't know, 100% revenue growth in nominal terms. But if inflation was also 100%, TMS 29 would show zero real growth.
Exactly that. It strips out the illusion created by rising prices. When we compare Q3 2025 revenue to Q3 2024 revenue using these reports, we are comparing apples to apples. Same currency value. It lets us see the real underlying performance changes in volume, efficiency, market share.
And this adjustment process has another side effect, right? Something about monetary gains or losses.
Yes, that's crucial too. Because the value of money itself is changing, the standard forces companies to calculate the real gain or loss they experienced simply by holding monetary assets like cash or monetary liabilities like debt. This gets reported in the profit and loss statement as the net monetary position gain losses. We'll definitely come back to that figure. It plays a big role later.
Got it. Context is king here. So, with that TMS 29 filter firmly in place, let's look at their top line. Hashtag TAG 2.2 revenue growth, Hasılat. What was the headline revenue, the Hasılat, for the consolidated group over these 9 months?
Consolidated revenue hit 34.178 billion Turkish lira for the first 9 months of 2025.
34.2 billion TL. And how does that compare to the inflation-adjusted number for the same period in 2024?
In 2024, the equivalent figure was 30.540 billion TL.
Okay, so that's a difference of about 3.6 billion lira. What does that translate to as a real growth percentage after TMS 29 has done its work?
The real term growth rate comes out at 11.9%.
11.9% real growth. That's actually quite strong, isn't it, considering the economic environment?
It's a powerful number. It tells you that despite all the challenges, despite the inflation pressures, TB Gaida managed to grow its business in real terms. They either sold significantly more volume, captured more market share, successfully raised prices above the general inflation rate, or some combination of all three.
And it validates that aggressive store opening strategy we talked about. More stores should mean more sales.
Absolutely. This top-line growth suggests the expansion is, at least from a revenue perspective, paying off.
Now, where did that 34 billion lira actually come from? Is it all just people buying food in the restaurants?
The vast majority, yes. But the breakdown is interesting. Direct restaurant sales were the giant slice, accounting for 29.75 billion TL. So yes, fundamentally they sell food to people.
Okay.
But the other streams are significant too. Franchise revenue, that's the fees and royalties they collect from their franchise partners, brought in 3.86 billion TL.
Still a sizable chunk.
And then there's another piece, franchise restaurant sales. This is where TB Gaida sells supplies and goods to their own franchisees. Using that big internal supply chain we mentioned, that added another 727 million TL.
Ah, so they're monetizing their logistics and supply capabilities through their franchise network as well.
Exactly. It shows how integrated the model is. They profit not just from the end customer, but from servicing their own partners too.
Okay, so 11.9% real revenue growth sounds great, expansion's working, but the story starts to shift quite dramatically when we move down the P&L, doesn't it? What happened with gross profit?
It did grow, yes, but only just barely. Gross profit went from 5.302 billion TL in the 2024 period to 5.622 billion TL in 2025.
So revenue up 11.9%, but gross profit only up, what's that, about 6%?
Roughly, yes.
Yeah.
And that immediately tells you something important. Their cost of goods, sold the direct cost of the food, ingredients, packaging, must have risen almost as fast as their revenues. The gross margin got squeezed.
Pressure right from the start. Okay, now for the really crucial line item, the one that tells us about the core business profitability. İsas Faaliyet Karu, core operating profit. This strips out financing, taxes, other weird stuff. How did the actual business of running restaurants do?
This is where the narrative takes a sharp turn. This is the shocker, really.
Yeah.
Despite that nearly 12% real growth in revenue, core operating profit decreased.
Decreased by how much?
By 5.2%. It fell from 2.774 billion TL in the first 9 months of 2024 down to 2.629 billion TL in the same period of 2025.
Hold on, let me get this straight. They opened 145 new stores. They grew real sales by almost 12%. And the result of all that effort, all that investment, all that logistical complexity was a core business that was less profitable than the year before.
That's precisely what the inflation-adjusted numbers show. It's the single most important finding from the operational side of this analysis.
That seems deeply problematic. What does it imply?
It implies that the cost of generating that extra revenue was incredibly high. Every lira of new sales came at a lower margin. The cost base, think labor for all those new staff, rent for all those new locations, general overhead for managing nearly 2,000 restaurants, it escalated faster than they could hike prices or find offsetting efficiencies.
So the expansion, while boosting the top line, actually eroded the profitability of the core operation.
It appears so. This forces us to stop celebrating the revenue growth and start digging really deep into the costs. Why did this happen? Where are the expenses spiraling? That's where we need to go next.
Okay, let's put the cost of sales, Satislan Malieri, under the microscope. We need to figure out what chewed up the profit from that 11.9% real revenue growth.
Well, the first thing you notice is just the sheer size of these costs. It reflects the scale we've been talking about. Within the cost of sales category, the biggest single item remains. First, material and material expenses, basically, the food ingredients.
And how did that change year over year?
It climbed significantly from 10.25 billion TL in the 2024 period to 11.59 billion TL in 2025. That's a jump of over 1.3 billion lira in real terms.
So that reflects the higher sales volume, obviously, but maybe also higher input costs. Like the price of beef or buns went up more than general inflation.
That's highly likely. It suggests they probably couldn't pass on the full increase in their raw material cost to customers, contributing to that margin squeeze we saw at the gross profit level.
Makes sense. But you mentioned earlier that labor was a key factor tied to that massive hiring spree. Where does that show up?
It shows up right here. Is another huge component of the cost of sales, staffing nearly 2,000 restaurants, training almost 3,000 new people. It hits hard. Personnel expenses within the cost of sales category reached 6.308 billion TL in the first 9 months of 2025.
And compare that to 2024.
In 2024, the inflation-adjusted figure was 5.472 billion TL.
So that's an increase of, what, over 830 million lira? Just on personnel directly tied to sales.
Exactly. Over 800 million lira real-term increase. It's the direct financial consequence of that rapid expansion hitting the reality of wage pressures in the Turkish economy. These aren't optional costs. You need people to run the stores.
So materials and labor are two huge chunks eating into the profitability of each sale. Hashtag tag 3.2, the unique cost of leases. Now, for a company with almost 2,000 physical stores, real estate has to be a massive factor. They rely heavily on leasing, which brings in this accounting complexity, TFRS 16, the lease accounting standard. Can you break down how this impacts their books?
Right. TFRS 16 is a big one for retailers like this. Essentially, it says that long-term leases aren't just simple rent expenses anymore. You have to recognize an asset on your balance sheet, the right to use the property over the lease term, and a corresponding liability, the obligation to make those lease payments.
So it brings those long-term rent commitments onto the balance sheet. How big are these numbers for Tied Gota?
They are substantial. The reports show total lease liability short and long-term combined of 5.86 billion TL, and matching that, they have usage rights assets, Kulanim Haki Varluklare, valued at 8.61 billion TL.
So nearly 6 billion lira in lease obligations recognized as a liability. It's not bank debt, but it's a definite long-term commitment they have to pay.
Absolutely. It has to be serviced. And this structure changes how lease costs flow through the profit and loss statement, too. Instead of just seeing rent
You
expense,
see other things, like what?
you see two main non-cash expenses related to these leases. First, interest expense on the lease liability itself. But the bigger one typically is the amortization of that right of use asset, basically depreciating the value of their right to use the property over time.
And how much was that amortization charge?
It was significant. For the first 9 months of 2025, the amortization of these ROU assets hit 2.43 billion TL.
Wow, 2.4 billion lira. That's a huge non-cash expense hitting the operating profit line.
It is, and it's one of the major contributors to that decline in core operating profit we identified, even though it doesn't represent physical cash going out the door to a landlord in that exact period.
Okay, but not all rent gets treated this way under TFRS 16, right? What about leases where the rent changes based on how well the store does, variable rent?
Yes, this is a really interesting strategic element. Many retail leases, especially in food service, have a variable component, often tied to a percentage of the store's sales. TFRS 16 says you don't capitalize these variable payments. They are treated as regular operating expenses when they occur.
So how much did Team Yuta pay in these variable sales-linked rents?
It was a very substantial amount, 1.865 billion TL in the first 9 months of 2025.
Nearly 1.9 billion lira? Just in variable rent payments.
That's right. It's a critical number. It shows that management actively uses these flexible rent structures. The upside is, if a store performs poorly, the rent drops, providing a safety net.
But the downside?
The downside is, when sales are growing strongly, like their 11.9% real growth, a significant chunk of that hard-won revenue immediately flows out to landlords through these variable payments. It acts as a kind of cap on the potential profitability of the core restaurant operation, especially during growth phases.
So success gets shared pretty quickly with the landlords. Another major cost pressure point, hashtag TAC 3.3 selling and general and administrative expenses. Pazarlama Ganel Yonatum Gideleri. All right, let's look further down the cost structure. What about overhead, marketing, central admin costs? How are they doing on brand promotion?
Marketing and advertising expenses seem pretty stable, actually, relative to the overall size of the business. They spent 1.454 billion TL in the 2025 period, compared to 1.418 billion TL in 2024.
So a slight increase, but roughly in line with inflation or maybe overall scale. Not a huge driver of the operating profit decline then.
Doesn't appear to be the main culprit, no. It suggests a consistent level of promotional activity needed to keep the sales engine running, but not a sudden, massive splurge.
Okay, but there's an expense item buried under other operating expenses that seems to perfectly capture their strategy. Pre-opening restaurant expenses, Asulish Ansezi restoring the Deleri. This sounds like the cost of future growth.
It is exactly the cost of future growth.
Yeah.
This line item is the financial footprint of that aggressive expansion plan. These are all the costs you rack up before a new restaurant can actually open and start generating revenue.
Like what specifically?
Things like paying rent on the location while it's being fitted out, the salaries for the initial staff while they're being trained, setting up initial supplies and logistics, all cash going out the door today for revenue hopefully coming in tomorrow.
And how much are we talking about here?
For the first 9 months of 2025, these pre-opening expenses hit 359.5 million TL. That's up from 313.6 million TL in the same period of 2024.
So over a third of a billion lira spent just getting new stores ready to open. That's a serious investment.
It's a massive bet. It underlines management's absolute commitment to grabbing market share and locking down those prime locations, even if it means absorbing significant costs that don't generate immediate returns.
And the fact that this cost line is increasing in real terms confirms they haven't pulled back on the expansion pace despite the margin pressures we're seeing elsewhere.
Exactly. They are pushing ahead with the rollout, funding it somehow, even though it drags down the current period's operational profit figures.
Okay, so let's summarize part 3. It feels pretty tough for the operations side. Real revenue growth is solid, but it's getting eaten alive by rising costs. We've got higher material costs, significantly higher labor costs, huge non-cash lease amortization charges, substantial variable rent payments flowing out, and heavy spending on pre-opening activities.
That combination perfectly explains why core operating profit fell 5.2% despite the higher sales. The cost engine is running hotter than the revenue engine.
Which brings us to the big mystery. We've established the core business is struggling on the profit front. So how on earth did their final net profit actually increase significantly? We need to move from the restaurant floor to the finance department. Okay, this is the big twist. We've spent all this time showing how the core business profitability, the Isas Faliat Karun, actually declined by 5.2% in real terms, yet the bottom line, the net period profit, jumped significantly. It went from 2.044 billion TL in 2024's first 9 months to 2.516 billion TL in 2025. That's almost half a billion lira more profit. Where did it come from?
Yeah, it's quite a reversal.
Yeah.
And the answer is, it didn't come from selling more burgers and fries more efficiently. It came almost entirely from things below the operating profit line. Financial engineering, smart cash management, and the effects of inflation accounting itself.
So non-operational factors saved the day for the bottom line.
Pretty much. 2 main drivers stand out. First, the net monetary position gains losses we mentioned earlier thanks to TMS 29. And second, massive income from their investments.
Okay, let's tackle the weird one first. The monetary position effect. Note 27. How did that help?
Right. Remember, TMS 29 forces you to calculate the real impact of inflation on your monetary assets and liabilities. In a high inflation environment, if you owe more money, monetary liabilities, than you hold in cash, monetary assets, you effectively gain for there, because the real value of your debt shrinks faster than the real value of your cash.
So being a net debtor is good in high inflation.
From this narrow accounting perspective, yes. Now, TIAB Gouda actually reported a net monetary loss in 2020 59M of 628 million TL.
Wait, a loss? How did that help?
Because you have to compare it to the previous year. In the same period of 2024, their net monetary loss was much bigger, 936 million TL.
Ah, I see. So the loss was over 300 million lira smaller this year. And that reduction in the loss flows through as a positive variance on the P&L, boosting the net result.
Precisely. It's not cash they earned, but it's an accounting gain, because the negative impact of inflation on their monetary position was less severe in 2025 compared to 2024. It's a quirk of high inflation accounting, but it had a big positive effect on the bottom line.
Okay, that explains part of the gap. What was the second bigger driver?
Pure cash generation from financial activities, investment income. Note 22. The total income from their investment activities was huge, 1.399 billion TL in the first 9 months of 2025.
Wow, 1.4 billion lira in income that's not from selling food. Where did that mainly come from? Is it interest?
Overwhelmingly, yes. If you look deeper in the note, pure interest income, Faiz Jalirleri, accounts for a staggering 1.376 billion TL of that total.
1.38 billion lira just in interest earned.
That's right. And you simply don't generate that kind of interest income unless you're sitting on a mountain of cash and deploying it very effectively in a high interest rate environment. Hashtag TAC 4.2 debt profile and net cash position.
That massive interest income completely changes the picture, doesn't it? It suggests TIAB Gouda isn't just a restaurant operator, it's also acting like a significant financial entity. What does their actual debt situation look like? Are they borrowing heavily?
Surprisingly, no. Not when it comes to traditional bank debt. Note 5 shows their short-term bank borrowings are really small, only 144 million TL, and they report essentially zero long-term bank debt.
So very little reliance on banks for funding. That gives them flexibility.
Maximum flexibility. But the flip side of low debt and high interest income is obviously a huge cash pile, was their net cash position. It's incredibly strong. Note 26 confirms this. As of September 30, 2025, they were sitting on a net cash position of 5.819 billion Turkish lira.
Nearly 6 billion lira in net cash. Wow. And was that higher than before?
Yes, it was up from 5.266 billion TL at the end of December 2024. So they added over half a billion lira to their net cash pile in 9 months.
And where is this cash held? Is it just sitting in current accounts?
Mostly not. Note 3 gives some color here. It mentions the cash is largely held in fixed-term deposits. And crucially, it states that during the third quarter of 2025, the average weighted interest rate they were earning on these Turkish lira deposits was 41%.
41%. Okay, now it makes sense. You have almost 6 billion lira in cash, earning an average of 41% interest. That's where the 1.38 billion lira in interest income comes from.
Exactly. That massive cash reserve, combined with the high interest rate environment in Turkey, is the real engine driving their overall net profit figure.
So the conclusion here is pretty stark. The struggles in operational profitability from the core restaurant business are being completely papered over, and then some, by the sheer profitability of their treasury function managing this huge cash balance.
That's a crucial insight for any investor. The finance department's success is effectively subsidizing the margin pressures being felt by the operations department. Hashtag 4.3 cash flow dynamics.
Okay, that leads us directly to maybe the most confusing part of any financial report, but arguably the most important, the cash flow statement. We've just established they made 2.5 billion in net profit and have nearly 6 billion in cash. So you'd expect cash to be pouring in from operations, right?
You would expect that intuitively. But when you look at the cash flow from operations, OCF, you find the exact opposite. It's consistently negative.
Negative. The day-to-day business is burning cash.
That's what this statement shows. This is the cash flow paradox we need to unravel. For the first 9 months of 2025, they reported an OCF outflow of 800.3 million TL.
800 million lira out of the business from operations. How does that compare to last year?
It was slightly worse than the 753.3 million TL outflow they reported for the same period in 2024. So the trend isn't improving. This confirms that the core activity, buying supplies, paying staff, running the restaurants, is actually consuming cash, not generating it, despite that healthy accounting profit figure.
How is that even possible? If you make 2.5 billion in accounting profit, how do you burn through 800 million in operating cash? Where's the disconnect?
The disconnect lies in two main areas: non-cash items included in the profit figure and changes in working capital.
Okay, explain the non-cash items first.
Well, that net profit figure includes big expenses that aren't actual cash outflows in the period, The biggest one we already discussed, that 2.43 billion lira amortization charge for the right-of-use assets. That reduces profit, but doesn't use cash.
Right. And the profit also includes things that aren't operating cash inflows, like that massive interest income.
Exactly. That 1.38 billion interest income boosts net profit, but it's classified as an investing cash inflow, not operating. So when you adjust the net profit for these large non-cash items, you start to see why the operating cash flow looks so different. But working capital is the other big piece.
Working capital meaning changes in receivables, payables, inventory.
Precisely. And this is where it gets really interesting. What drove the OCF negative? Well, there were large cash outflows for things like tax payments and payments for employee benefits, which is normal. But the really revealing factor is how they manage their payments to suppliers, specifically related party suppliers.
Related parties again? What happened there?
The cash flow statement shows a huge increase in trade payables owed to related parties. The increase was 1.68 billion lira.
Okay, wait. Normally, if your payables go up, it means you're delaying payments to suppliers, which should help your cash flow, right? It means cash isn't going out the door.
You're absolutely right. Increasing payables is a source of cash in the OCF calculation. And that's the critical point here. The fact that TA Beta still had a negative OCF of 800 million lira, even after benefiting from a massive 1.68 billion lira extension of credit from its own affiliated suppliers, like Fast.Gita, the food distributor, tells you just how much cash the underlying operations are really burning through.
Wow. So if those related companies demanded faster payment, the operating cash outflow would be dramatically worse, like potentially billions worse?
Potentially, yes. It highlights a significant dependency. The day-to-day operations are cash negative, and they are relying heavily on internal credit from sister companies, plus that huge interest income from the Treasury, just to keep the operational cash flow from being deeply negative.
That reliance on internal credit feels like a major risk factor we need to remember. Okay, so operations are burning cash. Where's the cash actually being spent? Let's look at investing cash flow. Does it confirm the expansion story?
Oh, unequivocally. The investing section is dominated by one huge number: cash outflow from purchases of property, plant, and equipment, CapEx. It totaled 2.961 billion TL in the first 9 months of 2025.
Nearly 3 billion lira poured into fixed assets.
Yes. Billions spent on land, buildings, restaurant equipment, fitting out those 145 new stores. It absolutely confirms the aggressive expansion strategy is real, and it's incredibly expensive. And crucially, this massive CapEx is being funded entirely by the company's existing cash reserves and that investment income, not by cash generated from the existing restaurants.
Okay, and lastly, financing cash flow. Where did cash move in terms of debt and equity?
Two main things dominate here. First, servicing those big TFRS 16 lease liabilities we discussed. Total cash payments for leases amounted to 2.004 billion TL. Second, significant dividend payments. They paid out 1.013 billion TL in dividends during the period.
So big outflows for lease payments and for returning capital to shareholders, primarily TFI.
Exactly. It shows they're meeting their major contractual obligations, leases, and are committed to shareholder returns, even while funding that huge expansion.
Okay, let's try to wrap up this section. TA Beta, a paradox. A giant in terms of liquidity, sitting on almost 6 billion in cash. But the core business operations are actually consuming cash. Net profit looks healthy, but only because of massive interest income and favorable inflation accounting effects. And they rely heavily on credit from related companies to mask an even larger operational cash burn, all while pouring billions into relentless expansion funded by their cash pile.
That captures the essence of the financial picture, yes. It's a complex balancing act.
You just highlighted again the reliance on credit from related parties. Given that TA Beta is controlled by TFI, this whole network of internal transactions detailed in Note 25 seems absolutely central. Is it fair to say this is maybe the biggest single area of complexity or even risk for an outside investor?
I think that's very fair to say. This related party network isn't just peripheral. It is the absolute structural backbone of the entire operation. These transactions are enormous, they're daily, and they tie together the entire supply chain, logistics, even delivery, all under that TFI parent umbrella.
Which can create efficiencies, presumably.
Absolutely. It can ensure stable supply, consistent quality, maybe even better pricing than the open market in some cases. But it also creates massive dependency and makes it really hard for an outsider to judge if the pricing is truly fair. You have to place a lot of trust in the auditor's sign-off that these deals are done at arm's length.
Let's put some concrete numbers on this dependency again, just from the first 9 months of 2025. What were the biggest flows?
The numbers are just huge. On the purchasing side, the group bought 12.575 billion lira worth of supplies from Fazdat Geda. That's the affiliated company handling food distribution for everyone.
12.5 billion lira. Just Fazdat.
Just a Fazdat. Think about that relative to their total revenue of 34 billion. It's enormous. They also bought 1.211 billion lira worth of kitchen equipment from another related company, Ms. Mudfak.
Okay, and on the other side, sales or services provided by related parties.
The big one there is delivery and collections. They processed 6.480 billion lira in sales or collections through ADIC Express, which is the group's own delivery platform.
Wow. Okay, that 12.5 billion lira purchase figure from Fazdat alone is striking. That's, what, nearly 40% of their entire inflation-adjusted revenue flowing straight back into one affiliated supplier. Does that create an unacceptable concentration risk, especially given the negative operating cash flow situation?
It certainly creates a high level of operational dependency. The benefit, as I said, is stability and control, huge pluses in a volatile market. But the risk is concentration. If Fazdat had a major operational issue or a financial problem, it would bring TV Aguida's entire restaurant network to a screeching halt almost immediately.
Because they have no real alternative supplier at that scale.
Not easily, no. And maybe more critically, remember our discussion about OCF. TV Aguida's operational liquidity relies on Fazdat extending that 1.68 billion lira in credit. So TV Aguida's ability to manage its day-to-day cash flow is directly tied to the financial health and willingness of its sister company within the TFI group to keep providing that support. It's deeply interconnected. Hashtag tag 5.2 financial risks.
Okay, let's look at risks beyond the related party maze. How do they manage credit risk with their actual sub-franchisees, the partners running individual stores?
They have a specific mechanism for that, outlined in Note 26. They mitigate the risk of franchisees defaulting on payments by requiring those franchisees to secure credit limits through intermediary financial institutions. It's like a guarantee system.
And how big is that safety net?
The total credit limit secured across all franchisees via this system is 137.5 million TL. So it caps TDAB Ghana's direct exposure if a franchisee runs into trouble. It provides a buffer.
Makes sense. Now, what about currency risk? Foreign exchange or KUR risky. They run global brands. They likely import some things, but earn mostly in lira. How exposed are they?
They state they have a net short FX position, meaning their foreign currency liabilities exceed their foreign currency assets. The report actually quantifies the sensitivity, which is helpful.
How sensitive?
They calculate that if the US dollar were to appreciate by 10% against the Turkish lira, holding everything else constant, it would knock 43.7 million TL off their pre-tax income.
Okay, that's material. What about the euro?
A 10% appreciation of the euro against the lira would have a smaller but still noticeable negative impact of 3.09 million TL on pre-tax income.
So currency fluctuations definitely matter to their bottom line. Even with hedging strategies, which they likely use, a strengthening dollar is a direct headwind for them.
It is. It's an ongoing operational risk they have to manage constantly.
Yeah.
Hashtag tag 5.3 equity changes and dividend policy.
Let's zoom back out to the balance sheet again. We saw the profit was up, driven by finance. Did the overall equity base of the company grow healthily despite all the cost pressures and payouts?
Yes, it did. Total equity showed decent growth, about 7.5%. It went from 19.87 billion TL at the end of 2024 up to 21.36 billion TL by the end of September 2025.
So the net profit was enough to cover everything else and still grow the equity base.
Exactly. That net period profit, driven largely by the financial income and the lower monetary loss, was the primary driver of the equity increase.
And what were the main things pulling equity down? Cash going out?
Two main factors we've already touched on. First, those large dividend payments, 1.013 billion TL flowing out to shareholders, primarily TFI. Second, they continued their share repurchase program. The report notes a small increase of 5.7 million TL in the value of shares they bought back during the period.
So returning capital via dividends and buybacks, but still growing equity overall thanks to that net profit. Hashtag tag 5.4 investment focus areas. We know they spent nearly 3 billion lira on CapEx. Let's drill down one last time into where that investment is focused, especially looking for clues about competitive pressures.
Right, the 2.96 billion TL in tangible assets, that's the headline, confirming the store building continues apace. They're also consistently investing in intangible assets, things like franchise fees, software licenses, rights to operate. That was another 183.7 million TL outflow, securing their future operational framework.
Okay, standard stuff for a growing franchise operator. But you pointed out something really interesting before, hidden away under other assets. This figure called Taliva Delery, evacuation costs or premiums. What is that and what happened to it?
This line item is fascinating because it speaks directly to the intensity of competition for good locations. Tali Bedellery is basically key money. It's cash you pay upfront to a previous tenant or sometimes the landlord just to get them to vacate a prime retail spot so you can move in.
Paying someone to leave so you can take their place.
Exactly. It happens when competition for the very best high-traffic locations is fierce. And the change in this number for Tibadja is dramatic. At the end of 2024, this figure was only 8.0 million TL.
Okay, pretty small.
By September 30, 2025, just 9 months later, it had exploded to 127.1 million TL.
Wow, from 8 million to 127 million, a 16-fold increase in just 9 months.
It's a staggering jump. And it's crystal clear evidence that TV Geta is aggressively fighting for the best real estate and is absolutely willing to pay significant non-recurring premiums to secure those locations ahead of competitors.
They're basically buying market access location by location.
That's exactly what it looks like. They view location quality as a strategic imperative worth paying a hefty premium for, even if it adds another layer of cost to their already expensive expansion. It's the price of maintaining dominance and securing future market share in a crowded market.
That single line item really does crystallize the whole story, doesn't it? They are number one, and they are paying a premium for everything required to stay there, prime locations, huge teams, and relying on that tightly controlled, expensive internal supply network. #outro.
So let's try to pull all these threads together for you, the listener, especially if you're thinking about this as an investment. What we've uncovered is, well, a really complex picture. On one hand, TIB Gutta is undeniably a high-growth machine. They're cash-rich, expanding relentlessly, pouring billions into CapEx, and even paying big premiums to lock down the best spots.
But that growth comes at a steep price. We saw high operational costs, especially for labor and those variable rents, squeezing the core business profitability. Core operating profit actually fell in real terms. And the day-to-day operations are burning cash, leading to negative operating cash flow.
Right. And the overall financial success story, that strong net profit figure, hinges heavily on things outside the core restaurant business. It's driven by massive interest income from their nearly 6 billion lira cash pile, benefiting from Turkey's high rates, plus those favorable inflation accounting effects like the smaller monetary loss.
And layered on top of all that is the deep integration with and dependency on that network of related TFI companies for critical supplies and, crucially, for operational credit. That introduces both efficiencies and significant risks.
So the current situation seems to be working, in a way. The strength of their treasury function is effectively bankrolling the margin-pressured operations and funding the aggressive growth. But this leads to a fundamental question, doesn't it? A question for you, the investor, to really ponder.
What's the question?
What happens if the external environment shifts? Specifically, what if inflation in Turkey starts to genuinely cool down, and as a result, those extremely high interest rates begin to fall significantly? That 41% average weighted interest income they're earning on billions in cash won't last forever.
Right. If that financial windfall disappears or shrinks dramatically.
Can the core restaurant business, which is currently struggling with profitability and burning cash, recover its margins quickly enough on its own to sustain this incredibly aggressive expansion model and continue generating the kind of overall profit investors have seen recently?
That really is the multi-billion lira question, isn't it? Are you investing in a highly profitable financial holding company that just happens to own restaurants, or are you investing in a cost-pressured retailer that's currently benefiting from a potentially temporary financial tailwind? Something to definitely think about.
Indeed.
Thank you for joining us on this deep dive into TIB Gota's financials. If you found this useful, please do rate, review, and subscribe for more detailed breakdowns of complex financial data. We'll see you next time.